Analyzing a company for investment involves complex math, accounting knowledge, and reading through loads of information. If that's what stops you from investing in the stock markets, you're in for a surprise. Philip Fisher, one of the well-known investors, introduced the concept of scuttlebutt in investing. As amusing as the name sounds, most successful investors follow this concept, including the legendary investor Warren Buffett. And by the end of this video, maybe you will too. Welcome to Upsurge, where we make finance fun, interesting, and easy, as it should be. And before we move ahead, make sure that you hit the subscribe button to make the YouTube algorithm work in our favor. In this video, we will check out the scuttlebutt approach that could make your stock investments a success. If you've tried reading the research reports, understanding valuation models, and studying the financial statements, I'm sure you must have been too overwhelmed, but still unconvinced. Well, that's where the scuttlebutt comes in. The term scuttlebutt is generally slang for gossip, similar to water cooler talk in offices. For investing, however, the scuttlebutt method was coined by Philip Fisher. Philip Fisher is considered a pioneer of growth investing. He founded an investment firm that delivered strong returns for his clients and influenced the greatest investing minds, including Warren Buffett. He was one of the first to consider a stock's worth in terms of potential growth instead of current price trends and absolute value. As a strong believer in long-term investing, he once wrote that if the job has been correctly done when a common stock is purchased, the time to sell is almost never. In his book, Common Stocks and Uncommon Profits, he gives 15 points to look for in stock before investing in, which focuses on high sales, great profit margin, strong cash position, efficient research and development, good employee relations, quality management, and so on. Today, you'll find several tools and screeners online that can help you narrow down the companies based on the criteria set in the 15-point checklist. However, what you cannot still do online is the scuttlebutt method that Philip Fisher introduced in his book. As you can probably figure out from its name, the scuttlebutt approach involves finding out about the company by speaking to people. But that doesn't necessarily mean speaking to your friend who keeps on giving tips on stocks, or your relative who cautions you against investing in the markets. The scuttlebutt method involves getting to know the company better by speaking to people who directly know the company, like employees, ex-employees, vendors, customers, competition, and so on. Employees and former employees often have a real inside view of the employer's strengths and weaknesses. Think of the companies that you've worked with. You would probably know them better than I do. Similarly, by speaking to the vendors, you can understand how often the company orders materials and services, how much they're ordering vis-a-vis competition, if they're making payments on time, and so on. This gets you insights on how well the company is performing. On the other hand, it is also helpful to talk to a company's customers to understand what drives their buying decisions, why they buy the company's products, and what will make them switch to competitors' products. And lastly, even the competitors and employees of competitors often have a surprisingly accurate picture of the strengths and weaknesses of the company. Apart from these, you will find many more stakeholders that you can speak to, depending on the industry in which the company operates. These are the intangible sources of qualitative information. The scuttlebutt approach is deeply rooted in the idea that these intangible factors have an enormous impact on the long-term value of a stock. And if you think about it, that makes sense. The scuttlebutt with people familiar with the company provides a far deeper insight and broader perspective that can't often be had through just reading the reports. For example, the former employees and current employees can give an understanding of the morale and culture of the company, which are often intangible and can't be put in numbers, but has a huge impact on the growth of the company. Also, the scuttlebutt is a form of primary research as compared to the stuff you get from reading research reports and financial statements. Primary research is important as it helps avoid everyone else's prejudices and gives you a higher level of confidence and conviction in your point of view. So, how exactly do you go about asking people what they think about the company? First, do preliminary research. The scuttlebutt method cannot be performed in isolation. It requires basic research about the company that you can do from its financial statements and then and only then talking to people with an educated mindset on the topic. It's only by first doing the due diligence can you decide if the company is worth digging into more, the right people to talk to, formulate the right questions to ask, and how to interpret and analyze that information. Second, avoid confirmation bias. One of the issues with conducting research in general is that with time, it often leads to some level of confirmation bias. What that simply means is that after some level of research, you could form a hypothesis and then look for people and things to confirm that hypothesis. However, it is important also to take in information that doesn't necessarily conform to your perception. Only then you can broaden your perception of the company and make a rational, impartial judgment of the company based on all the facts, good and bad. Third, network and engage. The scuttlebutt involves talking to people that aren't necessarily from our direct circles. And often a company or topic seems so obscure that it's difficult to know whom to talk to, or you feel awkward talking to someone about it. But in the era of social media, you'll be surprised by the power of network that you have. With the right approach, you'll find that most people love talking about their work, company, and industry in a genuine conversation. As you might have realized though, the scuttlebutt is a pretty time-consuming technique for investing. You can't possibly apply it to every listed company. You would end up taking too much effort to analyze the companies that could have been dropped much earlier. That's the reason you need your own decision-making framework and how you select the companies. And the scuttlebutt needs to be a part of that framework. There is no one correct framework that could work for everyone, and your framework is unique to you. However, it is helpful to understand how Fisher selects the companies as explained in his book. Firstly, out of hundreds of listed companies, Fisher considered around 250 companies from various sources of people that he trusted in the industry. Unfortunately, an average investor like you and me might not have such connections. Thankfully, you can use online tools and screeners to see portfolios of successful investors and also use your own filters for the initial screening of stocks. Fisher then narrowed down the list to 50 companies from 250. At this stage, he didn't do an in-depth analysis, but he glanced over the balance sheet, looked at the breakdown of total sales by product lines and profit margins, and evaluate the competition. Practically, this again could be done with the help of screening tools to select the best out of the best. With these 50 companies on hand, now Fisher applied this scuttlebutt technique along with his 15-point checklist. Out of the 50 companies, only 2 or 3 of them actually survived, as it was hard to tick all 15 boxes of Fisher's checklist. The final stage involved visiting the management of the business. Out of the 2 to 3 companies visited, Fisher typically invested in only one of them. This was a thorough process to find a single company out of 250 companies, which turned out to be a great success. And that's the reason Fisher was considered one of the greatest of all time. To conclude, the investing principle of Phil Fisher date back more than half a century, but most of his techniques are still relevant today. Even though today, high-frequency trading systems execute 1,000 trades a second, long-term investing still requires in-depth qualitative research. And the practical approach to research like Scuttlebutt guides you better to find businesses with the potential to generate long-term wealth. So, what do you think of this technique of stock research? Is that something you will follow for your investment decisions? We'd love to hear your thoughts in the comments. And if you're curious to learn more finance topics in depth in a fun and simple way, subscribe to this channel and make sure you check out our interesting financial courses on our website. If you enjoyed this video, please like it to show your appreciation for our efforts and consider sharing and subscribing so you don't miss out on our next explainer video on finance. See you.